Hey everyone, welcome back to Corporate Decoder, where we break down the confusing world of business for you. And today we're diving into Allarity Therapeutics' latest quarterly report, which involves some pretty interesting financial moves. And yes, we'll get to that big SEC fine later, but before we jump in, make sure you subscribe for more in-depth looks at these filings and join our Discord community link down below for even more discussions. Alright, so this is a Form 10Q, a quarterly report filed by companies with the SEC. Think of it as a mid-year checkup for Allarity Therapeutics. And the big news here is for the quarter ending June 30, 2025. Now, right off the bat, they mention their common stock, which has a super low par value of only $0.00001. Sounds small, but it's a technicality. The really interesting number here is that as of August 14, 2025, they had over 14 million shares of this common stock outstanding. Let's get straight to the heart of the matter, the financial tables. Looking at their condensed consolidated balance sheets for June 30, 2025 compared to December 31, 2024, we see some shifts. Their cash and cash equivalents went from about $19.5 million at the end of last year down to $17.8 million by the middle of this year. Not a huge drop, but it shows money is being spent. Overall, their current assets edged down from $20.3 million to $20 million to $20 million. This is typical for a company spending on research. On the flip side, their total liabilities decreased slightly from $10.8 million to $9 million. This is generally good news, meaning they owe less. Now, here's something pretty significant. The number of outstanding shares of common stock more than doubled from around 7.3 million at the end of last year to over 14.6 million by June 2025. This often happens when a company issues new shares, perhaps to raise money or as part of stock-based compensation. Following that trend, there are additional paid-in capital, which is the money shareholders pay. Above the par value of stock jumped from over $131 million. These strongly suggest they sold a lot of new stock. And even with that increase in equity, their accumulated deficit, which is the total net losses since the company started, grew from about $119 million to over $124 million. This means they're still losing money overall, which is common for biotech companies in development. They also showed treasury stock an amount of $2.5 million for over 2.4 million shares repurchased. This is the company buying back its own stock. It shows up as a negative in the equity section. Moving on to the statements of operations, we're looking at how much money they made or lost. Remember, these are for the 3 and 6 months ended June 30, 2025 compared to 2024. Their research and development expenses went up significantly. For the 3 months ended June 30, 2025, they spent $2.3 million compared to $1.1 million in the same period of 2024. That's more than double the spending. For the 6 months, it went from $3.2 million to $3.7 million, a roughly 15% increase. This usually means they're pushing their drug development forward, perhaps a clinical trial or manufacturing. General and administrative expenses, which cover things like salaries and office costs, actually went down. They spent $1.8 million in Q2 2024. For the 6 months, it dropped from $4.4 million to $3.4 million. This could be due to cost cutting or perhaps restructuring. So total operating expenses actually increased in the quarter by about $62,000, mainly driven by that jump in R&D. But for the first 6 months of the year, total operating expenses decreased by over $400,000 because of that drop in administrative costs. And their net loss for the 3 months ended June 30, 2025 was $3 million compared to $1.6 million in the prior year. For the 6-month period, the net loss was $5 million in the prior year. So they're still losing money, but maybe at a slightly slower rate over the longer period. Now, this table shows how the owner's stake in the company has changed. It's quite detailed, but highlights a few key points. Looking back at the start of 2024, they had preferred stock, a bit of common stock, and a significant accumulated deficit of nearly $95 million. By the end of 2024, that preferred stock was gone, and the accumulated deficit had grown to nearly $119 million. We also see the start of treasury stock from a share repurchase, and by June 2025, the preferred stock is still gone. The deficit is now over to $124 million, and they have about $2.4 million, and they have about 244 million shares in treasury stock, representing that repurchase we saw earlier. The main story here is the increase in common stock and additional paid-in capital, which confirms that share issuance we talked about. Let's look at where the cash is coming from and going. For the 6 months ended June 30, 2025, the company used about $8.2 million in operating activities. A big part of that was a $2.5 million settlement payment. The rest was for running the business and expanding that phase 2 clinical trial. It's pretty similar to the $8.7 million used in the same period of 2024. Financing activities brought in $8.6 million in the first half of 2025. This was mainly from selling shares through an at-the-market or ATM program to the tune of $9.7 million. But remember, they also spent $2.6 million buying back stock. In the first half of 2024, financing activities were much stronger, bringing in $27.7 million from selling shares. Overall, their cash balance decreased by about $1.7 million in the first 6 months of 2025. This is due to that cash outflow for operations and the buyback activity. Going into the notes, we find more details. Under liquidity, they acknowledge a significant accumulated deficit of $124 million and a net loss of $5.1 million for the first 6 months of 2025. But they believe their $17.8 million in cash is enough to operate for at least the next 12 months. They do caution that future funding will be needed for R&D and that negative events could impact their financial situation. Remember, they had 2 reverse stock splits in 2024, a 1 for 20 and then a 1 for 30. This makes the share count look much lower in historical data, but the total value of the company or a shareholder's stake is adjusted. It's like cutting a pizza into fewer but bigger slices. Now about that SEC investigation. In July 2024, they got a Wells notice concerning disclosures about meetings with the FDA. On March 13, 2025, they announced a settlement agreeing to pay a $2.5 million civil penalty, which they paid in April 2025. This seems to be a past issue resolved now. Under risk factors, they highlight that they've identified material weaknesses in their internal financial reporting controls, which could affect their ability to report financial information accurately and could weaken investor confidence. They are working on improving these controls. This table details their share repurchase program. In the 3 months ending June 30, 2025, they bought back over 2.4 million shares for about $2.5 million. They have about $2.4 million left to spend under that authorization. And finally, the signatures. The CEO and CFO sign off on the report attesting to its accuracy. So what's the story here? Allarity Therapeutics is undeniably in a growth and development phase. They've raised substantial capital by issuing new shares, which has boosted their cash position, but also diluted existing shareholders. They're spending heavily on research and development, which is a good sign for their drug pipeline progression, but it's also leading to continued losses and a growing accumulated deficit. The decrease in general administrative expenses is a positive cost management sign, but it's overshadowed by the R&D spending. They've managed to settle a significant SEC issue which removes a layer of uncertainty. However, the material weaknesses and internal controls are a concern and will need careful monitoring. Looking at it from a Warren Buffett style perspective, they are investing for future growth, but like many early stage biotech firms, the path to profitability is long and uncertain. Their main asset, Stenoparib, is central to their strategy and the increased R&D spend indicates progress there, but it's a high risk, high reward game. The share buyback is a bit unusual when they are still heavily reliant on external funding, but perhaps it's a signal of confidence from management or a way to manage share count. Overall, Allarity seems to be pushing forward with their core strategy, but needs to prove that their R&D investments will translate into successful products and ultimately profitability. Their ability to continue raising capital and effectively manage their extensive R&D is key to their future success. Alright, that's our breakdown of Allarity Therapeutics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord linked in the description for more insights and discussions. Thanks for watching. See you next time.